Hey, what's up guys, John here. Moody's just cut its outlook to negative for some of the biggest banks in the United States.
The United States outlook has been cut to negative from stable by Moody's,
saying the downside risks to America's fiscal strength have increased.
JP Chase, Wells Fargo, Bank of America, why are they doing this? Well, they look at the writing on the wall. Consumer deposits dropped by the most in 39 years.
Our deposits going out of the nation's banking system.
39 years, look at this. This is Fred's chart. This is Q4 of 2022, Q1 of 2023, Q2, and you see this is a record low. We just entered Q3, so this data is not yet available. But look at the GFC, the Great Financial Crisis, compared to where we are right now. We're in the silent depression, and Moody's is looking at the state of the U.S. banking system, looking at their loans, looking at the U.S. government, and they're seeing one problem after the next. In this video, I'm going to break it down and show you exactly what's going on. Please hit the like button. When you hit the like button, YouTube will share this content to educate more people about what's happening in America. And if you'd like to fix your credit, we'd love to help you. My company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free strategy session. Take a look at this. So, Bank of America, JP Chase, Wells Fargo shares shrug off Moody's outlook, cut negative from stable. Moody's negative outlook on bank debt reflects the potentially weaker capacity of the U.S. government in the United States of America. Look at what's happening here. This is pretty shocking. So we're right around here, right here. It says this means that if they do not pivot, this means more than 40% of U.S. tax receipts, which will be even less if markets tank, will be allocated to paying down just the interest expense on Uncle Sam's openly grotesque bar tab. You look at this. All the money we're sending overseas, all the money that's being allocated to other directions, and you see this rug pull that's ensuing on the U.S. economy. There is just no way that the U.S. consumer is going to be able to withstand more of this. Another 6 months, another year of this, consumers are going to continue defaulting left, right, and center. And this situation is getting out of hand. Bank profits fell 6% last year as war, inflation, and higher rates hurt yields. Then, U.S. Bank report $872 billion year-over-year drop in deposits. You have to ask yourself why. Why do they have these huge drop in deposits? Well, one reason is this. A lot of investors, a lot of Americans are looking for a higher yield. If their money is sitting in a bank account making, 20 basis points, it's not doing anything for them. They can move it into a money market account, like what they're doing now, and get 4.5%, 5% returns. And that's what they're doing. They're taking money away from the banks. Meanwhile, banks are sitting on record losses on commercial real estate, on a lot of their residential real estate loans, on their auto loans, on a lot of their business loans. They're sitting on losses after losses after losses. And how do banks make money? They lend money. They take consumer deposits, they lend it out. Well, when they have less money to lend out and a lot of their loans are going bad, it's a very, very big problem. So look at where we were in May 2020, right? Right here. This is and this is always the trend during periods of economic instability. Cash flows to money markets. Look at where we are right now. This is going to likely continue, and I believe it's going to be a very, very, very big problem for U.S. banks. Total deposits across U.S. banks fell on a year-over-year basis at June 30th for the first time on record, according to the summary deposits data from the FDIC. The U.S. banking industry deposits collected 4.8% year-over-year to $17.269 trillion. As bank runs contributed to 3 large bank failures the first half of the year, the drop was the first in data set dating back to 1994. The majority of large banks posted declines in their deposit balances year over year, with almost 30% of its $871 billion industry-wide decline attributable to Big Four banks, JP Chase, Bank of America, Wells Fargo. So these are the very banks that just got downgraded. So you start to pay attention to this, and it's very clear what's going to happen next. Bank lending is going to get greatly contracted. These banks are going to start batting down the hatches. They're going to try to hold on and try to weather this storm. That's what they're going to do. They have no choice. U.S. bank deposits fell for a third week to the lowest level in nearly 2 years, extended a year-long slide as customers continue seeking higher returns in money markets. Lending was little changed. Deposit commercial banks decreased $26.4 billion in the week ending in May 10th to $17.1 trillion. Right? So you're seeing this trend that's building out. and it's been building up for the last 6 months. One problem after the next is all adding towards more stress for banks. But what are consumers doing about this? Because this is a very, very, very pivotal time. They're filing, a lot of them are filing bankruptcy. A lot of them are just defaulting on their bills. They're looking at this student loan crisis saying, you know, what's a way out? What's a way out? Well, now student loan discharge is approved in most cases under new bankruptcy policy 3 days ago. You're going to start seeing more and more and more people filing bankruptcy, right? And so what many people don't realize, you file a Chapter 7 bankruptcy, that's sitting on your record for 10 years. You do that now, and let's say it starts Q1 of 2024, until 2034, it's going to be difficult to get loans, it's going to be difficult to get credit cards, purchase a house, buy a car, right? But you're going to start seeing a lot of people getting forced into this. But a lot of people want to walk away from their student loans, but with it, they're going to be walking away from the relationship with that bank. They're going to be walking away from a lot of their other obligations, right? This is what I think we're going to be walking into. We're going to be walking into a wave of defaults. That's what's happening. You look at where consumers are right now, they're burning about $150 billion per month. $150 billion per month. And in August 2021, they had $2.1 trillion. That money is set to run out at the end of December. So you start to pay close attention to this, and you see, okay, Moody's is saying, you know, you're going to cut its outlook to negative for good reason. For good reason. U.S. consumers are in really, really big trouble. And here's just a clear picture of where banks are. Here's a clear picture where banks are. Deutsche Bank will take a $350 million loss on a New York City office building they bought in 2014, nearly 10 years ago. Deutsche Bank is reportedly selling the office after its anchor tenant Bank of America left. 2014, Deutsche Bank bought the building for $500 million. The office is just 31% occupied after the recent loss of their anchor tenant. This comes at the same time that WeWork plans to break leases on 70 properties in New York City due to bankruptcy. And trillions of commercial real estate loans set to be refied the next 18 months, right? So you see what this is going to look like. We're going to be walking into a massive contraction in lending. That's what's going to happen, a massive contraction in lending. You want to put yourself in the best position possible, have the most relationships you can with solid lenders, whether it be credit card companies, banks, credit unions, whatever it may be. You want relationships and you want to have doors open because a lot of doors are going to close. The unfortunate thing is we just don't know which ones. But look at what Blackstone's done. Blackstone, their formula was just genius if you look at it from a capitalistic standpoint. They raised $30 billion, $400 million 6 months ago, right? Right around the same time that Signature Bank and Silicon Valley Bank failed, First Republic, you had PacWest getting acquired from Bank of California. You had all these situations happen, and Blackstone's raising tons and tons of money. And now they're looking to buy Signature Bank's commercial property loan, right? They're looking to buy it at a substantial discount. And we're going to start seeing more and more and more of these private equity firms and institutional investors and investors step in looking for ways in which they can monetize this situation. Blackstone is the lead to win a $17 billion portfolio of commercial property loans from the U.S. FDIC sale of Signature Bank debt. Bloomberg News reported on Sunday. In September, the FDIC was seeking buyers for its $33 billion commercial real estate loan portfolio, failed New York lender Signature Bank. The bidding process has brought in several finance companies. Starwood Capital Group, they own 180,000 housing units in America. It is just an insane amount of housing units, 180,000 doors. And Brookfield Asset Manager, according to Bloomberg News. Separately, the Wall Street Journal reported on Sunday, citing people familiar with the matter, that a venture of 2 nonprofits and related fund management is poised to win an auction for billions in Signature Bank loans banked by New York apartments. A former winner could be awarded as early as Monday. The FDIC hired Newark, right, in March to sell about $60 billion of Signature Bank loans after state regulators decided to close the failed lender amid turmoil in regional banks earlier this year. FDIC declined to comment on the Bloomberg News report, saying, "We only comment on sales after they close. The entire portfolio sale has yet to close." The agency did not immediately respond to requests for comment. So you know what's going to happen here. Massive consolidation of assets are going to be forming. Signature Bank, rent-stabilized loan draws, anemic interest. $33 billion. You just think about this. You have to ask yourself, are we going to see this continue to happen. More banks offering more and more debt, trying to sell these assets. I believe so. I believe so. But you have to ask yourself this big question. Over the last couple of years, you had many people going out there buying nice cars. I mean, one in six car loans in America is over $1,000 a month, $1,000 a month. You had people buying cars. They were, buying real estate. They were investing in everything. What do people do when they're pushed to the corner, right to the edge? They sell. They sell off assets. The big question is, if 2 out of 3 Americans have less than $400 in the bank, how can they make student loan obligations if each payment every month is $503 as an average, right? They're not going to be able to. You're going to start seeing more defaults. You're going to start seeing creditworthiness of borrowers continue to erode. You're going to start to see less available buyers out there to buy assets and more sellers that are distressed enough that they have to sell it. So what's ultimately going to happen? You're going to see a lot of Blackstones of the world, KKRs, Brookfield, Starwood. You're going to start seeing a lot of these entities start running out there trying to acquire debt and lend money. That's what's going to happen. They're going to try to acquire bad debt loans and try to lend money. It's obvious, right? I believe we're in the greatest wealth transfer of all time, and I think a lot of people are going to make a lot of money in the next couple of years, but a lot of people are going to lose a lot of money. At the end of the day, I've always had this saying. It's that real money is made during the bad times. Good money is made during the good times, right? You had some, good times the last couple of years. Some would say last decade or so. But the big problems are going to present the big opportunities. And I think 2024, 2025, if you have cash, if you have credit, if you have a game plan, if you have a business, or you work for an employer that's able to give you enough money, you're able to generate enough income every single month to where you can tuck some aside and go out there and invest, you're going to put yourself in a really, really strong position. Unfortunately, given the high cost of the world with record high inflation, if you're not increasing income at a faster rate than inflation, quality of living will continue to erode. I believe real inflation is way north of the numbers in which they report. I think it's probably closer to 20%. So if you're making $100,000 a year, hypothetically, you need to make $120,000 in 2024 just to maintain standards. That's if inflation doesn't get worse. Energy prices, all these problems don't get worse. You will probably want to double or triple your income, ideally over the next couple of years. And with the power of the internet, there's a lot of opportunity for a lot of people to go out there and make a lot of money. And I think that if you do that next couple of years, you acquire some great assets, you're going to put yourself in a really, really strong position. If you don't, I think life's going to get harder. What do you think about this situation? Drop below. We'll have a conversation about it. And if you'd like to fix your credit, we'd love to help you, give you a free strategy session in my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to GreatCreditFast.com. Click the link in the description and schedule a free strategy session. See you next video.